Is a global gold revaluation imminent? Prepare for the metals market reset. Could it be that we stand on the precipice of a financial seismic shift, a moment where the very bedrock of our economic understanding is tested and potentially redefined? Imagine a scenario where the ultimate safe haven gold isn't just seeing a modest climb, but a revaluation so profound it shatters all previous expectations, propelled by forces far more potent than daily market fluctuations. We are not talking about incremental gains, but a fundamental reassessment of value that could dramatically reshape wealth and stability. Indeed, the air is thick with apprehension across financial markets, a palpable sense of unease as investors grapple with volatility and uncertainty. The narrative shifts rapidly, with some foreseeing an inevitable market collapse, while others view the current turbulence as a fleeting prelude to an unprecedented boom. This dichotomy creates a fascinating, albeit stressful, environment where fear and opportunity dance a delicate waltz, leaving many to wonder where true value lies amidst the chaos. At the heart of this unfolding drama lies gold, an asset steeped in history and often sought as a refuge during times of crisis. After an impressive surge that saw it touch notable highs, the precious metal has entered a correctional phase. This pullback, while unsettling for some, is precisely what astute observers have been anticipating, recognizing it as a necessary cleansing of exuberance before the next significant move. Our analysis indicates that gold recently hit a significant technical target at approximately $3,948, prompting a temporary bounce before renewed downward pressure began to manifest. This pattern of reaching a resistance point, briefly consolidating, and then retreating is classic market behavior, signaling a period of reevaluation and consolidation among participants. The question now becomes, how deep will this correction go before a new foundation for growth is established? Looking ahead, critical support levels for gold are emerging on the charts, forming a roadmap for potential price action. The immediate attention turns to the $3,845 mark, followed closely by $3,695. However, the truly pivotal level, where long-term investors anticipate a major accumulation opportunity, rests around the $3,485 threshold. This is considered a maximum drawdown point, a price floor that, if reached, would represent a significant approximately $1,000 decline from recent peaks. This projected correction, while substantial, is not viewed as a bearish indicator for gold's long-term trajectory. On the contrary, it is widely interpreted as a vital reset, clearing out weaker positions and establishing a more robust base for future appreciation. Such pullbacks, although painful in the short term, are often the necessary precursors to powerful, sustained bull runs, allowing the market to consolidate gains and gather momentum. The historical echoes are profound, drawing striking parallels between today's market dynamics and the gold charts of 1979. A meticulous examination reveals an almost identical formation, a strong initial upward move followed by a consolidation phase. This uncanny resemblance suggests that historical precedents, while never perfectly replicated, can offer invaluable insights into potential future movements. In 1979, gold experienced a remarkable 9 consecutive months of upward momentum, culminating in a significant correction. Fast forward to the present, and we observe a similar pattern unfolding in the market, with an extended period of gains now giving way to a correctional phase. This mirror image of past cycles strengthens the conviction that we are currently navigating a familiar, albeit modern, market landscape. Yet it is crucial to acknowledge that while the chart patterns may rhyme, the underlying macroeconomic conditions of today differ significantly from the late 1970s. During the Volcker era, the Federal Reserve aggressively raised interest rates, reaching extraordinary levels of 15% to 18% to combat rampant inflation. Today, the prevailing sentiment is one of anticipated rate cuts, a stark contrast that fundamentally alters the monetary policy backdrop. Furthermore, the global debt landscape presents a dramatically different picture. In 1979, the debt-to-GDP ratio stood at a relatively modest 30%. In contrast, today's ratio hovers around an alarming 130%. This colossal difference in sovereign debt levels implies a much greater sensitivity to interest rate changes and a reduced capacity for traditional monetary tightening without risking economic collapse. These diverging macroeconomic factors lead to a crucial distinction in the expected aftermath of the current pullback. While the 1980 correction led to a multi-decade stagnation in gold prices, the present environment suggests a shallower and shorter retracement. The immense debt burdens and the propensity for central banks to intervene with rate cuts or quantitative easing will likely underpin a faster recovery for gold. The consensus amongst seasoned analysts suggests that gold will not only recover from this pullback, but will achieve new all-time highs by 2026. This projection is fueled by the unique combination of structural inflationary pressures, persistent monetary debasement, and increasing geopolitical instability, all of which enhance gold's appeal as a store of value. In a more audacious long-term outlook, a target of $10,000 per ounce for gold within a few years is not considered beyond the realm of possibility. This forecast is predicated on the acceleration of macroeconomic forces that diminish the purchasing power of fiat currencies and drive investors toward tangible assets. The sheer scale of global debt and potential future monetary interventions underscore this potential. This anticipated surge is driven by a confluence of powerful macroeconomic forces. Unprecedented levels of government debt across major economies, coupled with an insatiable appetite for spending, necessitate continuous money printing, which inevitably dilutes currency value. Furthermore, persistent inflationary pressures, often understated by official statistics, erode savings and prompt a search for inflation-hedging assets. Central banks themselves have become significant buyers of gold, signaling a shift in global monetary policy and a diversification away from traditional reserve currencies. Their actions validate gold's role as a fundamental pillar of financial stability, irrespective of short-term market fluctuations. This institutional demand provides a robust floor and potent upward pressure for the metal. The prospect of a global or domestic recession further bolsters the bullish case for gold. In such an event, governments and central banks would likely resort to massive fiscal stimulus and aggressive monetary easing, flooding the system with liquidity. Gold would be a primary beneficiary of this influx, as investors seek safety from currency depreciation and economic uncertainty. Similar to gold, silver is also positioned for significant long-term appreciation, albeit with its own unique market dynamics. As a pseudo-industrial metal, silver's price is influenced by both its monetary value and its demand from industrial applications. This dual nature can lead to sharper corrections, but also more explosive rallies during bull cycles. Current projections for silver suggest a significant pullback to around the $43 level, a critical accumulation zone for long-term investors. Below this, heavy buying is expected to commence, targeting a potential rebound. This price point represents a confluence of historical support and an ascending trend line, indicating a strong technical floor. The long-term outlook for silver is equally compelling, with analysts forecasting a potential move towards $100 per ounce in the coming years. This ambitious target is supported by the same underlying macroeconomic factors driving gold, combined with growing industrial demand for silver in green technologies and electronics, creating a potent cocktail for price appreciation. The current market action, including the sharp correction, is a necessary process to flush out the weak hands. These are typically investors who entered the market during parabolic surges, driven by emotion and short-term speculative greed, rather than a deep understanding of market fundamentals. Their capitulation creates a stronger, more resilient base for the next upward move. It's a common psychological phenomenon in markets. When assets move parabolically, novice investors are drawn in by the allure of easy profits. However, long-term holders of assets like gold and silver understand that true wealth accumulation in these markets demands patience, conviction, and the fortitude to weather significant drawdowns. There is rarely an easy investment when it comes to precious metals. A crucial observation from recent market behavior is the divergence seen in Bitcoin relative to the broader stock market. Historically, these assets have often moved in tandem, rising and falling together. However, Bitcoin demonstrated significant weakness even as the S&P 500 reached new all-time highs, failing to join the celebratory rally. This divergence has ominous implications. While Bitcoin struggled to make new highs with the stock market, it has recently mirrored the downturn in equities, taking a disproportionately heavy hit. This worst-case scenario, failing to participate in the upside but fully participating in the downside, raises questions about its role as a diversifier in the current market climate. Intriguingly, history offers a potential explanation for Bitcoin's peculiar behavior. In both the 2017 and 2021 bull runs, Bitcoin topped out approximately 4 to 6 weeks before the broader stock market. This pattern suggests that Bitcoin may be acting as a leading indicator, with larger, more informed players de-risking from digital assets first, anticipating a broader market correction. This historical precedence leads to a pertinent question for the current moment. Did Bitcoin's high in early October, roughly a month ago, signal the onset of selling by major institutional players who possessed foresight into the impending market downturn? This de-risking in digital assets could be a prelude to a broader reallocation of capital, potentially into more traditional safe havens or even out-of-risk assets entirely. As global markets continue to wobble, the interconnected relationship between gold, silver, and Bitcoin reveals crucial signals. Gold, the ultimate safe haven, faces temporary selling pressure as investors, driven by margin calls from plummeting stocks and crypto, are forced to liquidate holdings to cover their leveraged positions. This forced selling amplifies short-term volatility, but does not negate gold's long-term appeal. The excessive leverage pervasive in equity markets is a significant amplifier of this short-term volatility. When stock markets experience sharp declines, the cascade of margin calls forces investors to raise cash by any means necessary, including selling off holdings in historically stable assets like gold. This is not a vote of no confidence in gold, but rather a reflection of broader market stress. Despite these short-term headwinds, the broader trend for precious metals remains unequivocally bullish. The current correction, particularly if it reaches the $3,500 zone for gold, is seen as a potentially once-in-a-cycle buying opportunity. This setup positions the metal for a significant resumption of its climb towards record highs, potentially by 2026. For silver, a retracement below the $43 mark could present a similar compelling opportunity for long-term accumulation. As the weaker hands are flushed out and the market finds its equilibrium, silver is expected to follow gold's trajectory, driven by both monetary and industrial demand towards its own ambitious long-term targets. The message reverberating through the current market volatility is crystal clear. Pullbacks are not merely periods of loss, but profound opportunities for discerning investors. Managing leverage, exercising patience, and cultivating a deep understanding of market cycles are paramount during these times. The stage is being set for the next significant leg higher in both the metals and, eventually, the crypto markets. The global financial system stands at a crossroads, burdened by unprecedented debt and facing persistent inflationary pressures that show little sign of abatement. Central banks, constrained by their past policies, find themselves in a delicate balancing act, often resorting to measures that further erode currency values, making a compelling case for tangible assets. The coming years are likely to be defined by a continued reevaluation of what constitutes true wealth and stability. As confidence in fiat currencies wanes under the weight of fiscal expansion and monetary debasement, the intrinsic value of gold and silver will shine ever brighter, drawing increasing flows from both institutional and retail investors seeking sanctuary. This isn't merely about price targets. It's about a systemic shift in how value is perceived and preserved in an increasingly volatile world. The journey to $10,000 gold and $100 silver represents more than just a market rally. It signifies a broader acknowledgement of precious metals as indispensable components of a resilient portfolio, especially amidst a looming global rebalancing. The lessons from past financial cycles, particularly the 1979-80 era, offer invaluable context, reminding us that market patterns can repeat even if the underlying conditions vary. However, the unique combination of towering debt, unprecedented monetary intervention, and the potential for a new era of geopolitical tension makes this cycle distinct. Therefore, while short-term volatility and emotional reactions are inevitable, the long-term strategic imperative is clear. Recognize the opportunity presented by these pullbacks. For those who can see beyond the immediate fear, the current market environment is not a cause for despair, but a powerful invitation to position for what could be a historic revaluation of precious metals.